Start broadcast.
The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to the Smith & Gesteland series of Web Connect webinars. My name is Neil Fauerbach. I'm a partner with Smith & Gesteland. For those of you who don't know us, Smith & Gesteland is a local CPA and business consulting firm. We're about 85 people strong at our one office in Middleton. We have clients in manufacturing, supply chain, construction, high-tech, professional services, and nonprofits. We're particularly well known for our work with families and family businesses. We are pleased to be joined in this webinar by the Madison Community Foundation. The mission of the Madison Community Foundation is to use its local knowledge and assets to inspire giving, support meaningful initiatives, and connect people for the common good. Since 1942, they've been connecting generous donors with causes they care about most, helping them make a positive difference now and into the future. Today's topic is putting the plan into planned giving. Our presenters today are Ann Casey from the Madison Community Foundation and Theresa Zeidler-Shonat with Smith & Gesteland. Ann, who will present first, is the Vice President of Finance and Operations for the Madison Community Foundation, where she directs the financial and accounting activities for the foundation's assets, including oversight for investment management and policy development. She also assists individuals with planned giving and major gifts. Theresa is an accredited senior appraiser in the business valuation discipline. She specializes in business enterprise, equity, and intangible asset valuations for financial reporting, gift and estate tax, tax planning, succession planning, merger and acquisition planning and assessment, divorce and litigation support, and SBA lending requirements. Theresa takes a consultative approach to business valuation. In a role, she helps companies understand the value of their businesses and gives them the tools and information to understand how their actions can strengthen their business. As the webinar progresses, please type questions into your control panel. If we have time at the end, we will attempt to answer them. We'll be sending an email later this week answering your questions and providing additional information. We will start with Ann. Take it away, Ann Casey.
Thanks, Neil, and good afternoon.
Thanks, Neil, and good afternoon, and welcome everyone to the webinar. So since we're talking about planned giving today, we thought a good way to kick it off and set the stage would be by considering the impact of giving on our Madison and Dane County community. Now, for many of us, when we think of where philanthropy has impacted our community, we might first think of the large gift that created the Overture Center. But there are so many everyday, maybe less obvious examples of how we have all benefited from generosity and community giving. If any of us are asked about why we love the Madison area, we would probably put our lakes at the top of the list. But these wonderful natural assets require constant care and stewardship, work that is done by a number of nonprofit organizations. One of the leaders now is the Clean Lakes Alliance, which is pulling together many stakeholders to improve the quality of the Madison watershed. CLA is supported by many individuals, corporations, and foundations that have made grants to sustain their operations for several years. Have you been to the library lately? Today's library is a busy place. It's not like it used to be. It's a research center, it's a technology hub, and probably a neighborhood meeting place. Most libraries have friends groups that provide monetary and volunteer contributions to support operations. Many new community libraries have been built in recent years, all with the support of generous donors. Education is a favorite focus of donors, and many choose to give to their alma mater or create a memorial scholarship fund in honor of a loved one. And there are so many other ways to create educational opportunity, from school readiness programs for preschoolers to elementary school reading tutors and homework clubs to homework mentoring, high school mentoring relationships. Few business professionals would argue about the opportunity provided by a good job. Many business owners support employment opportunities by providing apprenticeship, intern, and mentoring opportunities, as well as financial contributions to training programs. Have you seen all the splash parks that have sprung up around Dane County? You can find them in Middleton, Mazomanie, Waunakee, Fitchburg, and several parks in Madison. None of them would have been built without community fundraising and contributions. Of course, we have to mention the many opportunities for all ages to enjoy and participate in the arts. These are supported by patrons and participants and parents of participants, all giving for both programs and facilities. Housing. Housing is arguably a necessary foundation for family stability, providing a basis for steady employment and education. Many agencies in Madison address housing needs. Porchlight, the Salvation Army, YWCA, Habitat for Humanity, the Road Home. Food. Food and nutrition goes beyond food banks and food pantries. Think of community gardens, meal programs at Luke House and the Catholic Multicultural Center, and the sustainable food systems supported by REAP Food Group. So now that we've reviewed some of the charitable opportunities there are to give to, let me talk about ways to give. Let's start by looking at the how, what, and when to give. When it comes to immediate gifts, of course, the most common is some form of cash, credit card, or more recently, small gifts given via your smartphone. This would probably generally not meet the definition of planned gifts. Not as common, though often much more advantageous to the donor, are gifts of appreciated property like stocks, mutual funds, business interests, or real estate. Other assets that people may find themselves owning more and more of, and so might consider giving away, may be retirement accounts, annuities, or insurance policies. You know, from a financial planning point of view, it can be puzzling that most donors make most of their charitable gifts with cash, not securities or property. In a typical asset allocation, cash is usually your smallest holding, yet that is what most people tend to give away to charity. So a big part of my mission today is to get you to think about other types of gifts that you can make. So let me first show you an example of why it makes sense to give appreciated long-term capital gain property and how it's a nice tax loophole to exploit. When you give appreciated property, you are allowed a charitable tax deduction for the full fair market value of the property. You also are not taxed on the gain on the property, and the charitable recipient, as a tax-exempt entity, does not pay tax on the appreciation. The gain just goes away. This is a great way to have the government help you pay for your charitable giving. So let's walk through an example with a stock worth $50,000, a basis of $10,000, an ordinary tax rate of 30%, and a capital gain rate of 20%. We can compare gifting the stock to charity with selling the stock and giving away the cash. If you first sell the stock to make a cash gift to charity, you would have a gain of $40,000 on the stock, and you would pay tax of $8,000. So in terms of your cost, you would give away the $50,000. You also have to write a check for the $8,000 of taxes, and you do get a tax deduction that might save you $15,000. So your net cost is $43,000. With a gift of stock, though, you have your gift to charity of $50,000 and the benefit of that deduction, but no tax on the gain. As I said before, the gain just goes away. So the net cost of that gift is only $35,000. Now you might be thinking, but I really like that stock. I think it's going to continue to appreciate, and I have enough cash available to make the charitable donation without selling anything. So here's another thought. After giving away that stock you like, you could take the cash you had available anyway and buy the stock again at current value to refresh that basis. Just another way the gain goes away. Now remember, the ability to give away taxable income and eliminate it forever is limited to that long-term capital gain property. Items that would generate ordinary income or short-term gains are not eligible for this special exception. For this type of property, your charitable deduction might have to be reduced, or you would be required to pay tax on the gain or the income. For short-term capital gain property, so that's property held less than 1 year, the charitable deduction would be just the basis of the property, so you wouldn't get a deduction or any tax benefit for appreciation. So here's another example. Under current law, if you give a portion of your IRA to charity, you will be treated as if you received a distribution from that IRA, and you'll be taxed on that amount. Then you're allowed a charitable contribution deduction, assuming you itemize deductions. Maybe it's a wash, maybe not, but there's really no tax benefit. In the case of S Corporation stock, you will get a charitable deduction for the fair market value of the stock, but your deduction will be reduced by any ordinary income component of the corporation. Here's where it's good to engage a valuation professional to not only value the stock you would be giving, but also the underlying component values of the company's assets. If the corporation would have ordinary income if its assets were sold, the best example might be inventory items, your charitable deduction would be reduced. In the case of real estate, you do need to be aware of any depreciation that might be recaptured as ordinary income if the property was sold. That too would reduce your charitable deduction. And if real estate or a partnership interest is subject to debt, there could be income recognized to the extent you're released from that debt when the property is gifted to charity. Now, some of these rules sound complex, and you may be thinking, shoot, I'll just write a check, or I don't think I can make a charitable gift. But no, that's not the point here. Many of these assets, particularly the business interests or real estate, can make really good charitable gifts, especially if you are in a situation where you are about to dispose of them, or will be forced to recognize gains. You would definitely want to look at charitable giving when a company you own is about to be acquired, or you've been approached by a very interested buyer for a piece of real estate you own. But you can see that all of these are examples where charitable gifting should include planning, so that you will be aware of the tax consequences of the gift before you begin to pursue making it. As Theresa will explain later, good planning can take time, so you will want to think of these things ahead of time. Now let's move on to some examples of more complex ways of structuring gifts to charity. First is the charitable remainder trust. Assets are put into the trust, then income from the trust is paid to an individual, often the donor. The trust continues for a set period of time or until the death of the individual, then the assets in the trust, now that's referred to as the remainder, are paid to charity. The payment of the income can start immediately or can be delayed for a time. Sometimes if the trust is funded with property, the payment of income doesn't begin until the property is sold and there's cash available to distribute. That can provide a way of sheltering some of the gain from sale. The amount of payout can be a fixed amount or can vary with the value of the assets in the trust. So you see there can be many creative ways these trusts can be structured. A charitable lead trust works in just the opposite way. Here the income during the term of the trust is paid to charity. Then the remainder goes to individuals, often family members of the donor. Some people see their home as an asset that they would like to give to charity, but of course they don't want to give it away while they still live in it. With a retained life estate, you can give the home to charity, but still have the right to live there during your lifetime. After you pass away, or if you decide to move out sooner, the charity is able to take full possession and sell the home or use it for its charitable purposes. You get a charitable income tax deduction for the value of that future interest. It will be really important that you and the charity have a good understanding of each of your rights and responsibilities while you are occupying the home, so this is another place that good planning and professional advice are critical. A charitable gift annuity is a fairly simple example of one of these split interest gifts. With the CGA, you make a gift to charity and the charity agrees to pay you a stream of income for your life and the life of another person if you choose a joint annuity arrangement. The income amount is a percentage based on your age. You get an immediate tax deduction for a portion of the amount you give, and the charity invests the gift and uses it to pay you the annuity. At the end of your life, the charity keeps the remainder of the gift. Almost every charity uses the same annuity rates recommended by the American Council on Gift Annuities. You see that the rates can be pretty attractive, especially at older ages. Some donors find these rates attractive because they compare them to the income they might otherwise get on certificates of deposit. Those donors tend to fund their CGAs with cash. But a CGA can also be a good way to convert an appreciated stock holding that may not be paying a dividend into an attractive stream of income for life. Not every charity, especially smaller ones, might have a CGA program because it takes a bit of effort to manage and administer. But there are other charities, like community foundations or United Way, that are willing to hold CGAs that benefit other charities. So if you're interested in doing one for your favorite charity, you can usually check around and find a way to do it. Let me turn to a couple of other giving vehicles that you might use to do your charitable giving. Some people think of forming their own family foundation. Often this occurs at the time of the sale of a business, a sale of a property, or some other event that creates a significant increase in wealth. The donors will put assets in the foundation and then pay out charitable grants over time. It requires incorporating a separate entity and applying to the IRS for tax-exempt status. The foundation needs to file annual tax returns, keep corporate records, and hold periodic meetings. Most advisors will recommend that a foundation have at least $3 to $5 million of assets in order to really make it worth doing. One thing to note is that the private foundation is actually not really that private. Its tax returns are public information, so anyone can go online to see the value of the foundation, where it is invested, who the donors are, and how much they give to it, and where the grants are made. Another note, if closely held stock is given to a private foundation, you can only deduct the basis of the stock. The gift does not get the tax benefit of that example we talked about earlier. One alternative to a private foundation is what's called a donor-advised fund. It lets you do the fun stuff, making grants to your favorite charities, without the trouble and expense of all the administrative requirements of the private foundation. A donor-advised fund is a sub-fund within a larger public charity. Community foundations and faith-based foundations have a long history of holding donor-advised funds, and more recently some financial firms have formed nonprofit subsidiaries to also get into the business. These are simple to create and usually have low minimum balances to begin. You make gifts into your donor-advised fund and recommend to the community foundation how you would like the grants given out. Though these funds are held by public charities, they can operate quite privately. The community foundation's tax filings are public information, but they contain no information specific to any particular sub-fund, so no one can see the gifts to your donor-advised fund, the balance of the fund, or what grants you recommended. And the recipients of the grants can be told by the community foundation that the grant came from an anonymous donor. Some donors find this very attractive. So before I spend some time on estate giving, let's do a quick poll. Do your will or other estate planning documents include any gifts to charity?
Give it 10 more seconds. %, 37%. Nobody yes.
So not too many yet have considered some gifts in your estate plan. Well, let's talk about that. First, I'll give a few examples of the types of charitable plans that donors can make. The first story is a couple who currently have a donor-advised fund that they use to support a variety of grassroots organizations each year. They are concerned about how the agencies will be supported after they pass on. So their estate will add a significant amount to the donor-advised fund, with instructions that the fund continue to make annual contributions to their favorite nonprofits for 10 more years, until the fund is exhausted. Every few years, during their lifetime, they review the list to make changes in the names and amounts for the nonprofits as the agencies or their interests change. Here's another example of a woman who had a variety of charitable interests and 2 adult children in the area. She made a bequest out of the residue of her estate. That bequest was to be split several ways. She wanted to make one last small contribution to 20 of her favorite charities. She endowed 2 scholarship funds, and she created a donor-advised fund that her children and their families could use for their future charitable giving. Now, planned giving in your estate is a matter of considering who you want to benefit from your estate, family and friends, the community and charities, or if you have a large estate, the government, which will collect taxes on it. Then you determine how you want to pass the assets to those beneficiaries. It doesn't need to be complicated at all. The fact is, 90% of planned gifts are simple bequests in a will or the beneficiary designation on an asset account. You can write a provision in your will or trust that leaves a certain dollar amount, a specific asset, or a percentage of your estate to a beneficiary or charity. You can also put a beneficiary designation on a bank account, insurance policy, or a retirement account. That doesn't even require a provision in your will and can be easily changed just by going back to the company that holds the account. When you make a bequest to charity, it's really important that you use the accurate name of the charity, be clear on what you want them to receive, and how you want them to use it. This slide has some sample language that would cover all of that. Now, before I turn it over to Theresa and the nuts and bolts of the planned giving process, I will finish up with some rules of thumb on giving and things to think about. As we talked about earlier, there's a definite advantage to donating long-term capital gain property to charity during your lifetime. The main examples of these would be stocks, mutual funds, or real estate. You get an income tax deduction for the full value of the property and do not recognize any taxable income on the gain. The gain just goes away. At death, though, there is no particular benefit to giving these in-kind assets to charity. These are good assets to leave to family members or other individuals at death. At that point, the basis in the property is stepped up to the value at death, so the individual can sell the property without paying any tax on the gain that accrued up until that point. Once again, the gain goes away forever. We also talked earlier about the issues that might arise when ordinary income property is transferred to charity during your life. These assets, like savings bonds, commercial annuities, or retirement accounts, can actually be very advantageous to give to charity at death. If they pass to family members or other individuals, those persons will pay tax on all the accumulated income, just as if you had cashed them in yourself. But a charity is exempt from income taxes, so the entire asset will pass to the charity free of tax. When you are doing charitable gift planning, there are some key things to consider. First, of course, are your own values and interests, what you want your gift to accomplish, and what organizations are best positioned to accomplish that. You also want to consider the most advantageous way to give. Are there assets other than cash that you can use? Will there be tax consequences, good or bad, to giving away that asset? What would be the other consequences of a nonprofit owning the asset? This is particularly important when giving away a portion of an asset, say stock in a private company or a piece of real estate that you own with others. Are there restrictions on you transferring that asset? What will be the impact on other owners if a new owner, the charity, comes into the picture? What about the impact to you if you no longer own that asset? Will you need the income that the asset was generating, or might you be able to structure the gift, maybe using a charitable gift annuity that would actually increase your flow of income? The nonprofit may also have issues to consider when accepting a gift from a donor. Many will have gift acceptance policies that require them to sell non-cash gifts as soon as possible. When it comes to closely held stock or real estate, you as the donor may be very knowledgeable about whether a market exists for the asset and can help connect the agency with resources to sell it. Donors will often offer to gift an asset to charity when a business is about to be acquired or there is a very interested buyer for some real estate. This can be a very good situation for both parties, so long as the charitable gift is made well before a final sale arrangement has been made. The charity, not the donor, must be the one to agree to sell the asset. Good professional advice is critical at these times. I once worked with a colleague who cautioned, "Beware of gifts that eat." That is very good advice, as a charity must always consider the risks and costs of owning an asset that a donor wishes to give. These might include the costs of accepting, holding, or maintaining the asset, or any potential liabilities that might follow the property. A nonprofit should never put its other assets or mission at risk when accepting a gift. Even though charities are tax exempt, they are required to pay income taxes when they own certain business interests, so good professional advice and knowledge of these issues can be very important. And finally, the charity must have a good understanding of how the donor expects their gifts to be used. They have an obligation to honor donor intent and must be confident that they will be able to fulfill that.
Thank you, Anne. As we go through the nuts and bolts of the gifting planning process, the first thing we wanted to touch on is who should be part of your planning team. Obviously, you want to consult with your tax advisor, your attorney, an appraiser, but you also want to consult with the giving coordinator at the charity or charities that you are hoping to support. Obviously, I'm not a tax advisor nor an attorney, and I'm not a giving coordinator, which is why Anne is here. I am, however, an appraiser. And so that is the majority of what I'm going to touch on here. Before I get to the nuts and bolts, though, let's talk a little bit about why people give. In 2014, U.S. Trust and the Eli Lilly Foundation did a study of why people give. And these were high net worth people, but they can apply to most people. 74% had a belief that the gift can make a difference. 73% did it for personal satisfaction. 66% did it to support the same causes that the organization they were giving to supported. I'm sorry, that was 66%. 63% did it to give back to the community. And 62% gave because they served on a nonprofit's board or they volunteered for a nonprofit. What's missing there? Well, only 34% of donors cited tax advantages among their chief motivators for giving. However, even if they aren't a primary motivator, tax advantages do exist. There are also impacts on what you need to include on your tax return when you do charitable giving. The study I just quoted also found a strong relationship between donors' knowledge of giving and their personal fulfillment for giving. So congratulations on joining this webinar. Your knowledge base just increased, so therefore your fulfillment will as well. Most non-cash gifts have some sort of valuation or appraisal requirement related to taking a charitable deduction on a tax return. So when do you need to do an appraisal? Artworks with a total claimed value deduction at or exceeding $20,000 must have a complete signed appraisal by a qualified appraiser attached to the return. There are also some IRS requirements regarding photo documentation that you need to be aware of. Any personal property with a claimed deduction exceeding $250 must include with the return a written communication from the qualified organization containing the name of the organization, the date of the contribution and the amount of the contribution. This really won't impact your business interests much, hopefully. When we're talking about personal property, what do we mean? In general, personal property is any asset other than real estate. The distinguishing factor between personal property and real estate is that personal property is movable. Examples of personal property include vehicles, furniture, boats, collectibles, that sort of thing. You as a donor must have an acknowledgement stating whether the organization provided any goods or services in exchange for the gift, and this is back to that lower level of giving, and if so, a description and a good faith estimate of the value of those goods or services. Any personal property with a claim deduction exceeding $500 but less than $5,000, you must complete Section A of Form 8283 and attach it to the tax return. This includes donation of household contents exceeding a claim of $500. Any personal property with a claim deduction of $5,000 or more, Section B of IRS Form 8283 must be completed, and this includes the qualified appraisers and donees' signatures, and this then must be attached to the tax return. A qualified appraisal must be prepared for the donated property, and this is why I'm talking to you today. This applies to single items or multiple similar items of personal or real property. So if you have many similar items and the total of your deduction is more than $5,000, you then need to do the appraisal process. And so when do you need to do this appraisal? You might be thinking, I have this appraisal I had done 2 years ago. Is it good for this tax return? The answer is no. Your appraisal for a tax return must be effective as of the date of the donation and must have been prepared no more than 60 days preceding, or the date of the donation, or no more than 60 days preceding the donation. You can have the appraisal done anytime up until the point at which you file the tax return, but the effective date or the valuation date, the as of date, is that 60-day window up to the date of donation. And so here we have a poll question for you. How long do you think a typical business appraisal process takes? Is it 4 to 6 months, 3 to 6 weeks, 2 to 3 months, 1 to 2 weeks, or 3 to 4 days?
All right, we'll give about 30 more seconds. %65 have voted. They're trying to make up their mind. %68. Okay, here you go. Here are the numbers, Theresa. 24% said 4 to 6 months. 19% said 3 to 6 weeks. 23% said 2 to 3 months. 27% 1 to 2 weeks. And 9% said 3 to 4 days. Some optimists there.
Okay, yeah, that's pretty optimistic, that 3 to 4 days. So here's a business interest appraisal timeline. This could be either an appraisal of your entire business or an appraisal of an equity interest in your business. You start the process with a project scoping conversation and an engagement letter. This then follows with an information and data request. The length of the information and data request step depends on how quickly you as the client respond with the requested information. There's then an initial modeling and industry research process, which takes 4 to 6 man days, not 4 to 6 calendar days, 4 to 6 man days to complete. This then goes to a follow-up questions for the client. There are often questions that arise during that modeling process. Once the questions are answered, and that answer depends on your client response time, the modeling and report finalization is completed. And then the final report is submitted to the client. In total, this process typically takes 3 to 6 weeks. This depends on a number of things. It can be affected by whether the appraiser you hire can start right away or has other projects that must be finished before starting yours, and responsiveness to information requests or follow-up questions. So that timeline is really sort of a best case scenario. You may also need a real estate appraisal, a machinery and equipment appraisal, an art or antiques appraisal. The timelines for these are different. A typical machinery and equipment appraisal, for example, appraisers will want to be in plant looking at shop equipment within 5 to 10 days from receiving authorization for the appraisal. And then a 100,000 square foot machine shop with standard equipment typically takes 5 to 7 man days to complete. So you can see that there are different types of timelines that you're looking at here for your appraisals. There's a whole lot of IRS guidance regarding appraisals for non-cash charitable contributions. Here is a non-exhaustive list, but these are the ones that are typically referred to. There's also other guidance in other places. You will want to consult with your tax professional about guidance on charitable contributions. But we'll talk about some of the things, some of the guidance that's included here. As I pointed out before, I'm not a tax professional, so always be sure to check with your qualified CPA, tax professional, for any clarification. Things that are not deductible, contributions to specific individuals. So, you know, if your brother Joey's a charity case, basically, and you're giving him money all the time, that's not deductible. Contributions to a non-qualified organization. Any part of a contribution from which you expect to receive or you actually do receive a benefit, such as sports tickets or a dinner. The value of time or services is not deductible. Your personal expenses are not deductible. And sort of touched on the IRA component. You'll want to talk to your tax professional about that. Appraisal fees are not deductible as a charitable contribution, but they may be claimed as a related business expense. So there again, good advice from your accountant is key. There are certain contributions to donor advised funds. There again, your tax advisor can talk to you more about that. And certain contributions of partial interests in property. Also, you may not deduct a charitable contribution of a fractional interest in tangible personal property unless all interests in the property are held immediately before the contribution by the donor or by the donor and the qualifying organization receiving the contribution. So, you know, to put this in perspective and kind of a very simplified example, if you and your cousin own a 50-50 share in an antique automobile, and you want to donate half of your 50% share to an organization, that would then not be a deductible donation. However, if you owned 50% of the automobile and the organization owned the other 50%, then your donation of half of a share might be deductible. All right, let's talk about something really interesting here. Let's talk about who can and can't perform appraisals. I'm getting funny looks from the people in the room. The IRS has a requirement that a qualified appraiser is used to perform appraisers. The IRS also excludes certain individuals from performing appraisals for tax purposes. So what's a qualified appraiser? A qualified appraiser has an appraisal designation from an appraiser organization, or has met certain minimum education and experience requirements. The IRS also requires that your appraiser regularly prepares appraisals for which he or she is paid, that your appraiser demonstrates verifiable education and experience in valuing the type of property being appraised, that the IRS hasn't slapped your appraiser on the hand and prohibited them from practicing before the IRS in the 3-year period ending on the date of the appraisal, and the individual is not an excluded individual. And we'll get back to that in just a minute. So who are appraiser organizations? I'm anticipating you'll want help finding an appraiser. For business appraisals, and again, this is not an exhaustive list, you can look to the American Society of Appraisers, the Institute of Business Appraisers, or the National Association of Certified Valuation Analysts. For machinery and equipment appraisals, Again, you can look to the American Society of Appraisers, the Association of Machinery and Equipment Appraisers, or the NEBB Institute, NEB. For art and antique appraisals, you can look to the American Society of Appraisers, the Appraisers Association of America, or the International Society of Appraisers. There are other organizations. I want to make that clear. This is a short list. For real estate appraisals, you can look to the American Society of Appraisers, the National Association of Real Estate Appraisers. The Appraisal Institute may be able to give you some guidance. The real key for real estate appraisals, though, is that your real estate appraiser must be licensed or certified in the state in which the property exists. So back to that excluded individual. And I think when you read between the lines on what an excluded individual is, you can find some pretty hilarious stories. So an excluded individual is the donor of the property or the taxpayer who claims the deduction. You don't get to pick the value of the property yourself. The donee of the property, they don't get to pick the value either. A party to a transaction in which the donor acquired the property being appraised, unless the property is donated within 2 months of the acquisition and the appraised value is not more than its acquisition price. This applies to the person who sold, exchanged, or gave the property to the donor, or any person who acted as an agent for the transfer or donor in the transaction. Other excluded individuals, any person employed by any of those people we just talked about. So for example, if the donor acquired a painting from an art dealer, neither the dealer nor persons employed by the dealer can be qualified appraisers for that painting. You'll often find that art dealers do act as appraisers. In this case, that specific dealer cannot be the appraiser. Any person related to any of the above persons or married to a person related to the above persons, and any appraiser who does not perform the majority of his or her appraisals made during her tax year for other people. That is, you can't have a pet appraiser. You have to have an appraiser that works for other people as well. You can have an appraiser that you rely on. That appraiser also has to work for other people. So talking about appraisals, the value of your gift may not be what you're expecting it to be. The IRS requires that the deduction on your taxes be at fair market value. The IRS defines fair market value as the price at which the property would change hands between a willing buyer and a willing seller when the former is not under any compulsion to buy and the latter is not under any compulsion to sell, both parties having reasonable knowledge of the relevant facts. Tax court decisions frequently state that in addition, both the hypothetical buyer and seller are assumed to be able, as well as willing, to trade and to be well informed about the property and concerning the market for such property. You'll also occasionally see a presumption in tax court rulings that the buyer and seller are at arm's length. They're not related parties. This isn't across the board, but you'll see that presumption fairly often. So when we're looking at gifts of interest in closely held companies, say shares in a closely held company, you probably have a buy-sell agreement in place, and if you don't, you should. We'll talk about that at some other point. If you have questions, let me know, but you probably should have one in place. The value noted in your buy-sell agreement is probably not fair market value. So if you have a buy-sell agreement, you can't use it for your charitable deduction value. There are also market participant considerations. Remember we talked about a willing buyer and a willing seller and a market for the stock? Well, someone outside of the company would value the ability to control the company more than they would value a partial interest in the company that didn't have controlling components. For example, people with control of a company have the ability to make decisions about how the company spends money. They have the ability to make decisions about how people are paid. They have the ability to make decisions about what new products to get into. That ability to control the company has value, and if you don't have that ability, you'll demand a discount in purchasing the shares. So this impacts the fair market value of a minority interest, a fractional interest. There's also an opportunity cost of investing in a closely held company. There's no ready market for that share, And so someone who invests in a closely held company, again here a third party, arm's length, willing buyer, willing seller scenario, that hypothetical scenario, would demand a discount for lack of marketability or the non-liquidity of the interest. They can't readily turn around and liquidate that interest. So both of those are considerations that the IRS will be looking for in your deduction for your charitable gift. Another thing to consider is that valuation is a point-in-time measurement. We already talked about the fact that the IRS wants you to have a valuation within 60 days of your gift date. But the other thing to be aware of is that value changes over time. There are market factors that impact the value of your gifts, whether there's a higher, relatively higher or lower demand. There are economic factors that can impact whether people are willing to buy or make a market in the gift, have a market in the gift. So if you had a valuation done 6 months ago, that value may not be what the actual value of the company is today, even to you the investment value to you may be different versus 6 months ago. Also, companies change. If you're valuing a company where the company is growing, in most cases a growing company will have increasing value. That sort of thing also is relevant to a valuation discussion or an appraisal discussion. Other things that can be gifted that need valuations are intellectual property, marketing intangibles such as trademark, artistic intangibles such as copyrights. There are other intangible assets. They're harder to gift. You probably wouldn't gift your customer base, for example, which is an intangible asset. When thinking about gifts of arts and antiques, a lot of people tend to look at auction prices for things and say, hey, that's kind of my fair market value. That's what my thing is. That's what my gift is going to be worth. Well, typically auction prices include both buyer and seller fees. Auction houses like to promote themselves by including buyer and seller fees in their sales prices, and they're not actually the fair market value of the transacted asset. Likewise, your insurance appraisal is replacement cost, the cost to replace the item with something of similar function, similar value. It's not the fair market value of your actual item. So a lot of times your insurance appraisal will be something higher than the fair market value of your asset because your asset will have had some physical or functional depreciation. Likewise, eBay isn't a good source for value estimates, so please don't use eBay when you're looking at the value of your arts and antiques. A good appraiser could potentially use it as an input to an appraisal, but it isn't a great place to estimate the value. All right. The IRS has some restrictions on charitable deductions for intangibles. Your initial deduction for contributions of certain intellectual property might be the lesser of your basis in the property or the fair market value of the property. Some transfers of property are not deductible. If it's a transfer of a partial interest, to the extent that consideration is received for the transfer, if the transfer is inadequately substantiated, and to the extent that the property is overvalued. The IRS has of late spent quite a bit of time looking at the valuations of intangible assets that are donated. So this is something where you want to have a really good appraiser who has some experience with intangible asset valuations take a look. The IRS further noted in some guidance that the fair market value of a patent must take into account factors such as whether the patented technology has been made obsolete by other technology, any restrictions on the donee's use of or ability to transfer the patented technology, and the life of time remaining before the patent expiration. So there's some things to consider here if you're donating intellectual property. Other limitations on deductions: if your personal property donation has a fair market value that is less than your basis in the item, the claimed deduction is limited to the fair market value. That is, it's limited to the lower value. You cannot claim a deduction for the difference between your basis and the fair market value either. And this has been set out in pretty stern language. If you donate a property with a fair market value that's more than your basis, the donor, may have to reduce the fair market value by the amount of appreciation or the increase in value when figuring the deduction to be claimed. And here's something that affects any of you artists in the audience. Donation of self-created works. Since the 1970s, you as an artist may not claim the fair market value of self-created works donated by you, the maker, to a qualifying nonprofit organization. You can only claim the cost of materials used in creating the works. So how do you know you aren't gifting a problem? Do you have restrictions on transfer of your shares? Check your buy-sell agreement or other corporate documents. Can someone outside of your organization even own equity in the company temporarily, as the case may be? If there's a company buyback going on, the company may buy back the gift, but is there a restriction on a charitable organization holding it even for a short period? And let's talk about a really interesting illustrative example of a problem. The art dealer, Ileana Sonnabend, had a work in her collection, her estate, that was Robert Rauschenberg's Canyon. Now, Canyon was, as you can see here, a mixed media painting. So what's the problem with this piece? Well, let's take a closer look. Do you see this thing circled in red right here? Can you tell what it is? Let's take yet a closer look. It's a taxidermied bald eagle. A taxidermied and painted, I think, bald eagle, but it's a bald eagle. Under U.S. law, this can't be sold because it contains a taxidermied bald eagle. Actually, most people can't even own it, much less sell it. It's a violation of the 1940 Bald and Golden Eagle Protection Act and the 1918 Migratory Bird Protection Act to even own this painting. And on top of that, there are criminal penalties for anyone who takes, possesses, sells, purchases, barters, offers to sell, or purchase, or barter, or transport, or exports, or imports at any time or any manner, alive or dead, any part, nest, or egg thereof, any bald eagle. Sonnabend herself had an exemption to own the work based on a notarized statement that the bald eagle was stuffed by one of Roosevelt's Rough Riders prior to passage of the laws. However, it couldn't be sold or possessed by anyone else, which leads to a question. How can it have a fair market value if it is illegal to have a market for this item? 3 separate appraisers valued it at 0. And so the problem? The IRS disagreed and said it was worth $65 million. They imposed penalties, late payment, and additional taxes. It went to tax court. The ultimate resolution? The IRS agreed to drop the fines and taxes if, and only if, the work was donated to a U.S. institution and the estate could not claim a charitable deduction on it. It's in the Museum of Modern Art's collection today, so the pictures I had of it came from MoMA. So as you can see, some of the things that you might want to gift might have a whole lot of baggage associated with them. This is a pretty extreme example, but you need to get some pretty good advice to determine whether or not the things that you're wanting to gift have any sort of issues like this. So what's next? Well, you want to think about what you want to support. Where are your values? You want to think about which of your assets is the best gift to support it. And here, as we've been talking about, it might not be cash. You want to talk to your legal and tax advisors. You want to talk to the giving coordinator at the charities you want to support. Line up the appraisals you'll need. And finally, feel good about supporting the things that matter to you. And so, Neil, do you have time for a few questions?
We do. We have a couple of minutes for questions. A couple did come in for Anne, so why don't you go ahead and read those, Theresa?
Sure. And one of the questions for you is, you were talking about giving away stocks with capital gains. But I have lost a stock in a loss situation. Can I give it to charity?
Well, Theresa, you touched on this a little bit in your slides, but you're right. In my presentation, I was thinking optimistically that folks have appreciated securities, and we were talking about that. In the case of property or stock where you have a loss, the best thing to do is to just sell it and take the deduction for that loss, and then give the resulting cash to charity. Because as you put in your slides, the amount of the deduction is going to be either the lesser of that value or your basis. So you're better off selling it using that basis as the measure of your cost and then getting that deduction.
Okay, it looks like we have another question. And the question is, I have some ideas about things that I want to give, but I don't know what organizations are best to use. How can I find out about that?
Well, there's a couple of online resources that you can use to research charities and to search for charities that do the things that you want to support, and to also look at the kind of the business aspects and the financials of these charities. You can look at guidestar.org, you can look at Charity Navigator, you can search on those sometimes for fields of interest or keywords that those charities work in. You can also use some local resources. The Community Foundation can always be a great resource because we give a lot of grants in the community, and so we can consult with you and are glad to do that. You come to us and you say, I'm really interested in organizations that work with preschool kids and readiness for kindergarten. You know, tell me where that good work is being done, and we're more than glad to do that for you.
All right, thank you, Ann and Theresa. Thank you, participants, for joining us. As you leave the webinar today, please take a few minutes to complete a very brief survey that will help us improve future webinars and also help us create some follow-up to you with some of the questions that came in that we weren't able to get to. Watch for an email answering your questions. This webinar and slides will be posted online on our webpage, sgcpa.com, for you to view again and to pass on to colleagues. We appreciate you being here. Have a great afternoon.